Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow. And after many times speaking with us, we have Jim Bianco back, who is always really interesting for us. And I have to say, Jim, you've been on this inflation call all year long, and man, you've been right on the money. So congratulations to you. Glad to have you.
Yeah, well, thank you. I'm glad to be here.
So with everything that came out yesterday, this is a great time to have an interview, really, because everything you've been saying all along, and then they came out yesterday. So share some thoughts with us there on what you think's happening.
It unfortunately is not good. I mean, just from a perspective that the majority of central banks, because I'm talking about what the Fed did yesterday, and I'm talking about what the ECB subsequently did the day after, and the Bank of England. And what you're hearing from the market is the belief is inflation is still transitory. I don't believe it's transitory. I think it's persistent. I'll talk about why that is. And therefore, the belief is the Federal Reserve is going to say a couple of things to kind of modify people to say, oh, yeah, we're going to be vigilant about inflation. But then they came out and they said that they're very, very careful to make sure that they don't upset the stock market. And so the stock market rejoiced with a giant rally yesterday. Now, look, I want the stock market to go up as much as anybody else, but I want it to go up for the right reasons. I don't want it to go up for manipulative reasons, that the Fed promises that, the printing press will just stay there and they'll just keep jamming money into the stock market and continuing to push it higher. So they've got a dilemma on their hands, I believe. On the one hand, I think inflation is persistent and it's real. And that persistent real inflation is most affecting the bottom 40% of the country. The bottom 40% of the country doesn't own a home, doesn't have a stock portfolio. They're getting a raise, but inflation's going up faster. So when they go to the grocery store, they see that they buy less every month, and they're not happy about it. And the president's approval rating and Congress's approval ratings are plunging because of that. And now that that's been happening, the Federal Reserve has been put under notice that they got to do something about inflation, but they're so afraid that doing something about inflation might lead to upsetting the stock market that they came out in favor of, we're going to deal with inflation as long as the stock market's okay with it. And we won't only go so far. And ultimately, short term, that's good. Stock market made a new all-time high yesterday. Long term, if they don't deal with this inflation problem, it won't be good.
And let me ask you, on that count, isn't it unfortunate that the country has come to a point to where, economics and business and all of that, as everything is turned to financial, everything. If it's not financial, it's not working. That's our whole, kit and caboodle here, and everybody is looking from young to old or whatever. I've never seen it like that in my entire career.
I have not either, and you're right. This is something that gives me a lot of angst too. This morning, as I was reading on the newswires, like on Bloomberg, Powell threaded the needle. A masterful job at the press conference. Why? What was masterful about it? He said some words, and the stock market went up. Is the definition of masterful. I, like you, used to think sound policy, good fundamentals, running things properly resulted in higher asset values. And that's ultimately the way it's supposed to be. It's not supposed to be manipulate markets up, and then hopefully everybody will then, chase price, or as they like to say in the crypto universe, number go up, and everybody's happy as well too. And that's where I've really, been upset about. Not upset. That's the wrong word. Disappointed in the way that the markets have been reacting, because it seems like that mentality has gotten to the point, like on social media. I put out a lot of stuff on social media. Sometimes I've even put out 100-year charts of demographics. And, and I've made some comment about it. And then I get people come back to me and say, okay, but do I buy or sell S&P futures tomorrow? Because that's all the thing that matters to them. And everything has to be boiled down to that. Okay, you said this and this about demographics and about, secular changes and stuff, but does that mean the S&P goes up for the rest of the week or not? And so that is ultimately not a good place to be. You're in that number go up kind of mentality. And yeah, I share your frustration because, like I said, financial markets are supposed to be a reflection of good ideas and good policies and right moves. They're not supposed to be the cause. That's what everybody thinks. If we just force markets higher, it will fix everything else. That backwardness has been around for a while. And ultimately, I think it's becoming untenable because we've got something we haven't seen in 40 years, persistent inflation.
Well, I know there's a few topics we discussed that you have some of your slides for, and you have the greatest information. You always have the best slides. And I thought you might share a few of those with on some of those two or three topics we discussed.
Yeah, so let me start by sharing this chart here with you as well. And this, to me, is when it comes to inflation, is the big issue. And then I can draw on the screen. So the blue line on this chart here is wage growth, weekly earnings. Their wages are up 4.8%, and as you can see, other than the pandemic distortion, that's a very high number. Okay, people are getting a raise. The problem is the inflation rate's up more than that. So if you look at the bottom panel, real hourly earnings, you'll see that it's negative. That means that every month, my paycheck cannot buy me the same things that it bought me in the previous month as well, too. So that is a problem when it comes to inflation right now, is that wages are not keeping up with inflation, and everybody's falling further behind. I went to the grocery store. I bought less this month than I did last month for the same amount of money. We forgot how it was in the late 70s. And that's what it was in the late 70s, and people got very, very upset about it in the late 70s. So I think ultimately, when it comes to inflation, that is the big issue that is driving inflation. So if I was to share another thing on my screen, where's that showing up? Just a couple of other things. CNBC did a poll about Biden's approval rating, and the economy takes another hit, and he was at 41% on that poll. But more importantly is this statement down here, and this is showing up in a lot of polls. Inflation has now firmly eclipsed the coronavirus as the number one concern for the country, followed by immigration, crime, and climate change. Number one concern in the country right now is inflation. Another poll, Barron's highlighted, 69% of the public disapproves how Biden is handling inflation. So what you're seeing is his approval rating is falling quite a bit. And what's sort of new is there's this thing called the generic ballot where they ask people in polls, are you going to vote for the Democrat or the Republican? Not by name. And so here it shows the last 5 years. The bottom panel here shows you the net number. And the net number is positive, means more people say they're going to vote for Democrat than Republican. That number is plunged into negative, meaning more people are going to vote Republican than Democrat. It's flipped, and it's flipped in the last 2 months. And what has really caused it to flip more than anything else is inflation. Inflation is the biggest issue right now. It is really upsetting a lot of people. So why is that important? Yes, the Fed is easy. And yes, the Fed gets, threaded the needle, and you did a good job because words fell out of Jay's mouth and the stock market went up. And that's the definition of a good Fed policy as well. Because for the last 13 years, why wouldn't that be the policy? What's the downside of that policy? Well, now we've got one. We've got one in inflation, and we've got one in the public that is not enamored with stock portfolios and home prices going up, is not happy, and it's taking, and I want to say this in a nonpartisan, it's taking it out on the majority party. And if the Republicans were in charge and the same thing was happening, they'd be taking it out on the Republicans, but they're not in charge, and it's happening with the Democrats. So now the Fed is going to be under enormous pressure. Do something about inflation. Well, if I do something about inflation, I might upset the stock market. Well, if you don't do something about inflation, the Democrats are going to get wiped out in November. So there's a pushback to this, because 2 years ago, it was do something about the economy falling with COVID. Well, print money and throw it out the window. Well, what's the downside to that? None. Print money and throw it out the window. Well, now there is a downside, and that downside is real inflation. And unfortunately, the way we seem to be dealing with it is we seem to be in somewhat of a denial phase, thinking that inflation is still transitory and it will still go away.
Let me ask you, I was in a conversation yesterday. I was listening actually to two are three fairly large multifamily developers in Austin, Texas. And obviously, everybody thinks that, they were showing how much rents would go up this year, what they were expecting next year. These numbers are like high. They're like 15 and 14 and that sort of thing. But isn't there a spot there where that 40% you're talking about says, hey, I can't pay that anymore. It doesn't work for me.
Oh, I think that spot has already come and gone. They can't pay it. Doesn't work for them. They're not relocating for jobs. They're very upset. The other thing about the numbers too, because people have pointed out, if you look at consumer confidence in November hit an 11-year low. Stock market's at an all-time high, and it hit an 11-year low. Public, one of the things I've heard people say along those lines with the 40% is that, well, the public, if the stock market goes down, it'll scare the public in thinking that the economy's bad. They already think it's bad. If the stock market went down, they'd say, well, of course, we think that this economy is bad to begin with, and stuff like that. But in part of that is they're getting priced out of a lot of things. The average used car price, used cars are up 50%, since March of 2020. Rents are soaring. The grocery store is soaring. Yeah, they're getting 5% more, but it isn't covering all of this stuff. And that's why they're very upset about it. And yeah, in Austin might be an outlier, Ted, because you're a boom town. Everybody's moving there. People that have some wealth are coming in, and those developers might be right for what they're doing. But when you go somewhere else, like Eastern Texas or something like that, where the incomes are not as high and stuff, those people are really being squeezed, and it's showing up in the polls. And that's why I think the Fed's going to be hearing from the administration. In fact, Axios had a story about 2 weeks ago. For the first time since the Carter administration, a president is asking the Federal Reserve to become more hawkish because they want them to do something about reining in inflation because it's killing them.
So let me ask you, so yesterday they go to the $30 billion they're going to cut back per month. You think they'll really go through with that?
Yeah, I think they will go through with that. Right now, there's a disconnect in the marketplace. There's a real disconnect, and that is between what the market thinks and what everybody else thinks as well, too. And I've not seen this, and so I'll share this with you on my screen as well, too. This table shows you what the market expects the Fed to do this year. They expect the Fed to hike one time in May, maybe March, a 43% chance that they will hike in March. They expect a second hike in July, maybe June, a 43% chance in June. It's not 50, but it's close. They expect a third hike in December, maybe November, 44%. And a fourth hike in February of 2023 is a possibility as well, too. So 3, maybe 4 rate hikes. So when you say the Fed's going to follow through on it, what's interesting is when people ask me, what's your opinion about the Fed? I say 3, maybe 4 rate hikes in the next 14 months. Wow, you're an outlier. I just explained what the market's priced in. I've not seen where the market pricing is the outlier. Everybody seems to think, yeah, well, that's what the market's pricing, but there's no way they're going to do that. They're going to come up short of that because inflation is transitory. It will start to go away. They can't upset the stock market because for 13 years, there was never an offset. Print money, push up stock prices. Well, where's the offset? Who loses in that? Well, we never had inflation. Now we do. That's the offset to it as well. So yes, I do think that they'll follow through on the $30 billion, and I think that they'll start raising rates because I do believe that inflation is persistent and it's going to stick around. I do believe it will peak in the first quarter and it will start down. Oh, look, it's over. No, look to see how fast it takes for it to go below wage growth. So when you go to the grocery store, you buy the same amount of stuff as you did last month. That still might take, so a lot of economists have looked at this, that still might take 12 to 18 more months. That's not acceptable. The public's very upset about inflation now. Oh, don't worry, it's only going to be another 12 to 18 more months of this, and then we'll be through it, if that's even what happens. I think that they'll find that unacceptable, and the Fed will be forced to move faster.
Well, they forget about all the people in the country that go paycheck to paycheck. They forget about that part of it. So let me ask you, though, I'm assuming that you think you'll have to finish, you have to quit buying altogether as far as that goes, and then you would start to raise rates. You wouldn't continue to buy even a small amount and still raise rates. That wouldn't make any sense.
Right. The Fed he was asked that yesterday in his press conference, and he said, look, at the rate we're going, that we're going to reduce, they're buying $90 billion worth of bonds a month. So they're purchasing securities to help suppress interest rates at a rate of $90 billion a month. They're going to reduce that to 60, 30, and 0 by March is what they're going to do. And they said only when they've stopped buying bonds will they start to raise rates. So that opens it up for the March meeting. They've got a meeting in January, and then the next meeting after that's March. So it's only 2 meetings away. Now, if there's a reason that they need to move faster, they could announce the January meeting, we'll go from 60 to 0 and raise rates then. But what they did say is that their target has always been maximum employment, that they wouldn't start raising rates till we hit maximum employment. Problem with maximum employment is they never define what that is. And then they came out and said, it might be different because of the pandemic. Well, no, yeah, I think it definitely is different because of the pandemic. And we might start raising rates before we hit maximum employment. So that was code from the Fed by saying as soon as they're done with the purchases, they get those to 0, doors open to immediately start raising rates, which is why on that table I showed you, there's like a 40% chance they move in March and a better than 50% chance that they move in May.
So do you think the bonds they do own now, Jim, I mean, do you think they just let them roll off, or how do you think they ever reduce that balance sheet?
I think they'll let it roll off for now. That's what their plan is to just hold them until they mature and then don't buy them back. Their plan is not to start to sell them initially. They're afraid of selling them because they tried that in late 2018 on making an announcement that they were going to sell off bonds. And what happened was the stock market didn't like it. They didn't like it, and then we had what was called the Powell pivot. Oh, I'm sorry. Okay, you don't like it. Well, then we won't do it because everything's got to be about pleasing the stock market. So I think what they're planning on doing is stop purchasing, raising rates, let bonds roll off. If at a later date they need to get even more aggressive, then they could maybe consider it. But that's probably not till 2023 if it gets considered at all.
And move on a bit to the bond and stock markets. I have to give you this. You said all along that the lowest bond yield was back in 2020 on the 10-year. Certainly was. It stayed that way. But I wanted you to comment on this now because you have some great bond graphs, and we'll get to some stocks as well. But on the bonds, there's a phenomenon going on now where the 20 to 30-year paper is actually declining in yield, and the 0 to 5 obviously is moving higher over this period. What are your thoughts on that? I mean, you're saying the bond market's telling him something different than he's thinking, or what do you think's happening?
Yeah. So let me graphically show you a couple of quick charts here that highlight this. So 2-year yields, the yield on the 2-year note was around 21 basis points, and it's been going straight up. And I might add, this has been a big surprise to everybody because short-term interest rates like this are supposed to be anchored by the Fed. The Fed is supposed to tell you when they're going to raise rates, and they're not supposed to move, kind of like they did for most of the year as well. And so they've been moving up quite a bit. At the same time, 10-year yields have been meandering sideways. And the result of that has been the yield curve, the difference between the 10-year and the 2-year, has been flattening quite a bit. What's the message that the market is giving us from all of this? And that message is, I believe, first of all, in a cynical kind of funny way, the Fed is really skilled at doing one thing, raising rates too much and breaking something. And so the market thinks the Fed's going to raise rates a lot because they're going to have to deal with inflation. And why is the long end then meandering sideways and the yield curve flattening? Because they're going to go too far and they're going to break something. And they might have no choice because the Democrat Party is going to be saying, keep raising rates because it's the only way we're going to not get wiped out in November of 2022 because you have to rein in inflation. And so they're going to go too far and they're going to potentially break something. So I suspect that by mid-year 2022, 6 months from now, that yield curve The difference between the 2-year and the 10-year might be zero, if not inverted. Now, an inverted yield curve now it's not now. So let's see if I'm right in that it becomes inverted in 6 months. But if it does, as I like to joke, there's a couple of things that happen when the yield curve inverts. First of all, everybody notes the yield curve has a 100% track record of leading a recession. When it inverts, a recession follows. And then everybody knows that all the PhDs come out and say, here's a paper you don't understand that says this time an inverted yield curve won't lead to a recession. And then it does. And then it ultimately does a year or two later. So that's kind of the pattern that we always have. So if the fear in the market is still that the Fed is going to have to raise rates aggressively and risk breaking something, then the yield curve will be flat to inverted in 6 months. And that will be your warning signal that the economy is going to have a difficult time in 23, maybe even a recession. Now, again, a couple things have to fall in place before that happens, but we seem to be headed in that direction right now.
That's sort of funny. I know you remember this quote by John Kenneth Galbraith that economic forecasting was designed so they could make astrology respectable.
Yeah, exactly.
So it was kind of along that line. So let me ask you, how would that lead you to look at the stock market? You've got quite a bit on the stock market, and how, things are expensive, and we really think they're expensive, but you've got some interesting information about pricing and where we are, value, all that sort of thing. You might share that with us.
So a couple of things about the stock market. This has been one of the narrowest rallies that we've seen in stock market history. And what I mean by that, you go back to May 15th, 7 months ago. In the last 7 months, the Russell 2000, which is the 2,000 smallest cap stocks, that index is down 2%. The world index X, the US, so the rest of the world, is also down 3%. So the world and small cap stocks have gone sideways to slightly lower over the last seven months. The S&P 500 is up 11% during that period, but 8 stocks in the S&P 500. The FANG stocks, the Facebook's now Meta, Apple, Amazon, Netflix, Google, which is now Alphabet, NVIDIA, and Tesla, and Microsoft. Those are the 8 stocks. Of that 11% gain in the S&P since May, seven of it is those 8 stocks. 4 of it is everything else. So the stock market is really, 8 stocks have done very well, and the rest of the world has been kind of treading water, is really what's been happening in the market. So it's been a very frustrating market for a lot of people in that respect, that unless you've been playing in those FANG stocks in Microsoft, NVIDIA, and Tesla, you have not seen the broad markets, the other markets advance. As such, the market is at a very, very high valuation right now. If interest rates are going to go up and the rest of the market is not performing and inflation is going to be persistently a problem, I think what you're seeing in the rest of the market will continue. It's been struggling for the last several months, and it will continue to struggle. The only question is when does those 8 FANG stocks in Tesla, NVIDIA, and Microsoft, when do those stocks, and believe those stocks are $11 trillion. They're 40% of the S&P, 8 stocks. That concentration has never been seen. Well, actually it was in the mid-60s. It hasn't been seen in 55 years, that kind of concentration in the stock market as well, too. But if those 8 stocks run into trouble, then what we're going to see is the pattern of the rest of the world in the stock market, which has been really sideways, if not a little bit lower, since spring.
Well, it poses this question, too, and we said this all along, that you have so many people have entered the investment industry since in the last 13 years, it'll be March of 2009. And they've never seen this flat market or up and down market where you really never went anywhere. And it's going to be interesting to see because a lot of people are in the industry now that have never seen anything go wrong in the market. And they're advising people. And so it always makes you wonder about what kind of advice they have since they've never been through it. For us, we've been humbled numerous times with those things. But what do you think about that?
Well, you're right. Not only have they not seen it, but they think they've seen it. What do you mean, Ted? I saw a 30% decline in the stock market last year. And then the Fed opened the windows, threw money in the streets, and it got all fixed, and it's all better. And that's how it's supposed to work from here going forward, right? Market's never allowed to go down. They'll just throw money in the street and fix it as well. And so but you're right. Other than that experience, they have not seen the experience otherwise. The biggest thing to keep in mind is a lot of people push this idea of the 60-40 portfolio, 60% equities, 40% bonds, because from 2009 to 2020, it worked great. It worked great, right? Stocks went up, and you got some upside appreciation. But then when things kind of got a little bit hairy, the bond part of it rallied, and it buffeted you. So it gave you returns with lower risk, and everything worked great. But what did we also have from 2009 to 2020 was no inflation. Now that we've got inflation, that stock-bond relationship is changing, and changing in a big way right now. It's becoming kind of 100-0, right? Stocks and bonds rally together. So when stocks go up, bonds go up, everything goes up, everything's fine. Yeah, but when they go down, they both go down together, and everything you own loses you money as well too. And if we run into that struggling period, that 40% leg, we've got 40% in bonds, that might not work as well as it used to. I understand it did work great, but the difference coming out of the pandemic right now is this inflation thing. It's changing a lot of relationships. And so that is going to be something that I think a lot of wealth managers, even people on Wall Street, they call it the risk parity trade, and a lot of other people are going to have to understand that relationship has changed, and changed quite a bit. And you don't have that natural hedge, that you can, what do I do if the market's going down? Because the implication there's always some big important market always going up and stuff like that. And we could go rush into that. It might be a lot more difficult, in 22, 23, 24 than it has been in the recent years.
Well, let me wind up with something for you, Jim, and I know this is not what you normally do, but if someone walked in here today and you and I were talking to them, and they had a liquidity event and they had $10 million sitting here as we speak and hadn't done anything, okay, where would you go with it, you think?
You mean not Dogecoin?
Well, yeah, maybe if
go
4 or 5 coins.
Go all in on Dogecoin.
Yeah, we have to be careful on the coins, don't we? Because they blast us if we say the wrong thing.
Right. And I was not giving investment advice. I was giving a joke. That was only for entertainment. That was only for entertainment purposes only, is what I said. So if you had $10 million, what would I want to do with the market? I would say you'd want to structure something to protect yourself against inflation. And you have to expect that we're going to have inflation going up, not 70s type inflation, but 3 or 4% type of inflation. Well, that doesn't sound like a lot. Yes, but when bond yields are at 150, 160, then all of a sudden the bond market is not going to be a place that you're going to find that protection. The stock market, there are places you can find that protection in higher yielding safe instruments that maybe yield more than that, or inflation sensitive type of basic materials, consumer cyclicals and that kind of or maybe even in alternative investments like in commodities, in real estate, in lumber, in oil and gas, or something, oil and gas master limited partnerships. But thinking along those types of lines, if they walked in today with $10 million, I think that the era of, we're going to have to go buy some unprofitable technology companies and shoot for the moon, that has worked. And there are some companies in that space that can work. But boy, that's like picking the lottery right now. You want to, but this whole idea, just buy an index of all of them and they'll all work, that's going to be difficult, I think, moving forward. That is the old cycle. The new cycle is going to be more about preservation than it's going to be about, opportunity of getting outsized growth.
Well, I think for those comments, because that's where we come down on Oxbow, we always say, hey, you got to live to play another day. And people forget about the object of investing is to maintain buying power. That's really the object of investing. But one of the things I remember, and I know you do too, was back in 1999, I know you have a list because I have one too, of all of those companies that were supposed to be the new paradigm companies, and they're all big zeros today. And it's always interesting to look back on them. because I know you've talked about him before. But listen, always great to have you. We want to have you back in person when we get this summit going again. But, you know, you always have the best information, Jim. So we hope to see you back, and we hope to get you back next year.
I really hope we get to travel and see each other in person. Thank you. Merry Christmas and Happy New Year to you and everybody listening.
Thanks, Jim. We'll see you then.